In the last couple of years, only the lazy haven't thought about getting into investing or trading. It's not surprising. Bitcoin has risen from $16,000 to $100,000, the American stock index S&P 500 from $1,000 to $6,000, and even the Russian stock market is doing quite well considering its high dividend yield. What's better to choose, investing or trading? Where can you earn more? Where are the bigger risks? How do you choose the best strategy for yourself? So what should a beginner do taking their first steps in the markets? Let's start with the basics. What is the bull market? The market is a place for redistributing money from the poor, greedy, and avaricious to the rich, patient, and influential. And it's not because the world is ruled by reptilian masons. No, it's simply related to the peculiarities of human psychology and how people are used to thinking, reasoning, and making irrational decisions in life. The second important point, markets live in cycles. From the cycle of maximum depression, of global financial crises, let's start over, least of all before, all sorts of pumping up of markets, money of global financial, in pumps of all assets, and before economic prosperity. On all fronts that we observe with you. Today and the third moment is important, which you need to understand about the market. If shoe shiners start talking about which stocks to buy, or which cryptocurrency to hold in your portfolio, then it's time to get out of the market while you still can. Does this mean that you shouldn't manage your money, that you shouldn't invest, or that you shouldn't be interested in the economy and so on? If you don't take an interest in finance, economics, politics, or history, then all these subjects will interest you. A simple example, if you don't invest your money, if it's just sitting in a bank account or under your mattress, you're losing value in rubles every year, 10-15% inflation. When we talk about dollars, it's 3 to 5-7%. That's just according to official statistics on inflation. Whether to manage your finances or not, to invest your money or not, is a rhetorical question. The real issue is to do it correctly and to have a proper attitude towards financial markets, which is exactly what I will be encouraging you to do in this video. An investment is the purchase of an asset with the aim of holding it long-term and earning financial profit from it. You can make a profit in two ways. The first is from the appreciation of the asset. Let's say we bought Bitcoin at $16,000 and sold it for $100,000, locking in a profit of $85,000 approximately. And the second way is to receive dividend income. Let's say we bought a share of Rosneft or Lukoil. Rosneft shares may not change in price as much as Bitcoin, but over this period they have paid us about % in dividend yield. Simply due to the risks in the Russian market, it is considered to be high yield in terms of dividends. In terms of profitability, the potential ranges from -99, meaning a complete loss of the asset you bought, to infinity. It's precisely because of the long time horizon. I can give you an example. Mr. Buffett bought shares of Coca-Cola from 1985 to 1990. The average price of the positions that Mr. Buffett acquired was around $2. So he built up his position over 5 years at an average price of $2 per share. As of 2023-2024, Mr. Buffett is already earning $2 a year just from dividends. Understand how the principle of compound interest and the accumulation effect works. You bought a share 30 years ago, time has passed. The stock has grown, the dividends have increased, and now you essentially receive as much money every year as you initially invested. I understand you can talk about inflation, but the shares of Coca-Cola have also grown. So you didn't just hold on to them for no reason. This is an example of a super rational, super healthy, super reasonable investment. We'll get to that too. In this video, we can say the same about Bitcoin. People who bought Bitcoin, let's say in 2013, $100, now they have a yield of tens of thousands of %. But let's be honest, making such deals in life is not something everyone can do. And this video isn't about some pink ponies, those billions and billions and the successful successes from Instagram. It's more about real grounded life. And maybe you'll be that lucky one who gets fortunate and you'll buy a hypothetical Bitcoin for a hypothetical $100 and sell it for 1,000 times more. But we wouldn't count on that. It didn't work out, so I will be talking about what has worked for me. There are two secret ingredients in investing. The first one we've already discussed is time, and the second is the choice of assets you invest in. Because this is exactly what will determine what time does to your investment. It either increases its value or accordingly devalues it. The example with Buffett and Colin is quite obvious. People drink cola. They drank cola 100 years before this and will probably keep drinking cola 100 years after this. So this investment only grows over time. If you buy at the same time, for example, shares of the company Kodak. Remember, there were those cameras they used to produce film and so on. Kodak was really hyped at one point, but they missed the moment when the market was taken over by digital cameras. You must know they missed the mobile phone market. And actually time These investments were rendered worthless simply because those companies went bankrupt and became worth tens of times less than what you would pay for them. So, when we talk about investments, the key point is to choose those narratives and assets that will remain relevant over a long period of time. If you really want to park your money for the long term, you need to think about what people will be using in 50 or 100 years. Most likely it will be the same things they used 100 years ago. Food, oil, clothing, technology. Technology, by the way, is in question, but cars will most likely still be around.
Nice.
And besides what we've discussed, there are 3 key rules in investing. First, finding the right entry point and a suitable deal can take years. A good entry point is your everything. If you bought something at its peak, like Bitcoin at $100,000, then you'll have to wait quite a while for it to make another 5-10 times and reach $1 million. And in order for us to show a good annual return, we naturally need to wait for some market fluctuations to choose good entry points and earn the maximum amount of money, of course, over a certain period of time. Global financial market cycles last about 4 years. 1 to 2 years of expansion, then 1 to 2 years of decline, followed by 1 to 2 years of stagnation. And after that, another growth phase begins. By the way, there's an interesting picture about how one economist in the early 20th century predicted most of the world's financial crises. By the way, it matches up quite well, and from it, we can estimate when our world is expecting new upheavals and when we need to hold cash to take advantage of the best opportunities. This is just a small digression. Many people do not understand this point, that in order to get a good entry into, but to buy good assets at an adequate price, you must have a lot. Cash, folks. So, if you're going to work and you haven't been saving your money, no matter what financial crises happen, you simply won't be able to make that life change you've been dreaming of. And here are 2 important points. The first is to work on your skills to increase your salary. And the second point is to have basic financial literacy in order to save money. I don't know, it might be a bit easier for me in this regard. I've been involved in this since childhood. With the first money I earned at 14, working as a laborer, I saved some of it. Then from 16 to 18, I also saved everything. And for me, it never happened as some kind of mystery of the world. But I know most spend money fully. I would do this for you, not recommend it. You'll never guess the bottom of the market. You could buy Bitcoin for $25,000 in 2020, in the second year, let's say, and it dropped to 20. You bought it for 20 and now it's at 16. Are you going to buy it? Let's go back to point 0. Do you believe in the asset you are buying? And the simplest question is to understand whether you believe strongly enough in the asset you are buying. It's about your willingness to average down, your readiness to pull out more money, your willingness to buy more at a lower price and be happy about it. That is dropping. You bought again Bitcoin for $25,000 or some stock. You see, it has dropped by 50%, so it has fallen by half. What do you do in this situation? You feel happy. Why? Because you wanted to buy some asset and now you can buy it with a 50% discount. This is the investor's approach. It's not like I bought something, it dropped by 50% and that's it. I just leave the market. Forget about it. Investing is not about falling in love. No, it doesn't work that way. That's exactly why people lose money in the market. That's why I said that investments and the market as a whole are a place for redistributing money from the hasty, poor, greedy people to those who possess some other quality. In investing, you regularly need to rebalance your positions, buying and selling. Assets that have either lost their relevance or, on the contrary, have become relevant. And accordingly, you need to rebalance your portfolio based on its goals, current narratives, and your planning horizon. I'll give you my example. My portfolio is generally divided into several parts. I have about 30-40% in the high-risk part. So these are stocks, growth stocks, not dividend ones, and crypto. And all of that, youthful, trendy, extreme. Next, about 20% is in real estate and all that stuff, concrete, which doesn't seem to grow in price, but it kind of preserves your money, roughly around 20-30%. And a third of the capital is in assets that I would call of medium reliability. In my understanding, these are dividend stocks. They might not be very profitable, they don't grow super well, but they do provide some real returns that outpace actual inflation. These are bonds just a little. At the moment, bonds are not doing a great job of beating inflation, but you can hold a little for diversification. And actually, my portfolio is roughly made up of 3/3. But you have to understand that I'm still quite a young person. If you're someone younger than me, maybe you don't need any conservative instruments at all, just crypto and high-risk stocks. If you're an older person, then probably for you, getting involved with highly volatile stocks or crypto for fun isn't exactly healthy either. No financial advisor will do that. Your money is doing well, and you need to understand that properly. Many people are swayed by bank brands, both Russian and foreign. It doesn't really matter. If you come to a bank analyst, to a bank manager who has a KPI, it's worth it to squeeze the maximum out of you and make sure that you make a large number of transactions. He doesn't care how much you earn. Believe me, the key point here is that you need to figure out for yourself how money works and what assets you are investing in. What assets? How long will you hold? People who work in bank, not interested in this. If the market is bullish and the assets go up, they'll celebrate with you and say, look how much money you've made. If, accordingly, what you bought falls, he will say, well, it wasn't us. Bad, this is life. It's bad, the market is bad, and so on. And I repeat, no one but you will take care of your money. In my opinion, there are areas in life that you shouldn't delegate. These are the areas of finance, health, and raising children, and this includes personal relationships. So we can really delegate other areas, like some household tasks, work tasks, and so on. But if we start delegating these 4 points, it doesn't work out very well. And maybe there's a situation like this, and I've seen it many times with my friends who, hoping that some analysts, bank employees, or I don't know, YouTube channels, or someone else will offer them a brilliant solution to all their problems and tell them exactly how to invest their money. Over the long term, the returns on investments are usually much higher. Because if we've chosen a good asset, it's in demand by people, or it provides dividend income, time is the investor's best friend. The longer time goes by, the more compound interest works in your favor, and the more assets you accumulate. With the right financial behavior, the second point is about investments. It's much easier for a beginner. Again, we'll talk about trading in a moment, but what are investments? You went in and picked something that's more or less reasonable. Again, we're not saying that, like, you bought Bitcoin at $100. We're talking about something that's more or less reasonable. So, an oil company in Russia, if you are a citizen of the Russian Federation, is, let's say, one of the main taxpayers that provides thousands of jobs. And the most important thing is that a product that is needed all over the world will most likely continue to exist. The same goes for McDonald's or Coca-Cola, for example, right? If people were drinking Coke and eating burgers at McDonald's 100 years ago, chances are they'll keep doing that. These are just hypothetical examples, not investment recommendations. The third point, investments don't require you to spend a lot of time in the market. And this is super important if you're working, running a business, and so on. To really invest adequately in crypto stocks and so on, you only need to spend a couple of hours a week. Seriously, there's nothing more to do. We check the charts twice a week, look at the news 2 or 3 times to see what's happening, and make some purchases if we spot good opportunities in the market. Yes, you will need to spend some time at first on learning to see how the market works, understand the cycles, figure out the levels, technical analysis, and fundamental analysis. But then it takes a minimal amount of time, seriously. The task is simply to buy at the right time, sit back, wait, and then sell. It's harder to lose all your money in investments. That's their fifth advantage. If you're investing in reasonable assets, many people mistakenly think that you can only lose money in crypto. But let's take a look at how they performed. Virgin Galactic stocks, targets in 2022, PayPal. You can lose money in the stock market quite easily. The same can be said about the Russian stock market. In 2008, Sberbank dropped from 100 rubles to 10. In 2022, it went from 400 to 100. It was painful, but who are these opportunities? Those who use these opportunities trusted these assets are profitable. So Sberbank is currently trading at 300. This is in response to the idea that you shouldn't buy at the highs. Sometimes finding a good entry point takes years. Years of waiting to buy good ones. Reliable, quality assets at a fair market price. Because if everything is good in the market prices assets unfairly. By the way, you should understand this too. An important nuance. A conclusion on the topic of investments. In my opinion, investing is a much more profitable strategy for most people. If you are not a professional trader, if investing is crucial for financial literacy, money dwindles in savings accounts without investments. Without investments, your money will just dwindle away. Don't think you can just put it in a savings account. You can't just buy bonds or do something else. You can only join the global market. In a growing market, buy appropriate assets, understand what narratives will emerge and what will last for decades. And to ride along with all of this, more on the global financial markets. So what is trading? Trading is making money from price movements. The key point is not about buying an asset to hold it and earn from its growth or dividends. It's about trying to profit from price fluctuations. So for a trader, it doesn't matter if the asset is rising or falling. In trading, you can make money both going long, trading for an increase, and going short, profiting from a decline. If you don't understand what long and short are when you watch this video, I think trading is definitely not for you. But still, we need to understand what it is. We can actually trade absolutely anything with you. You can buy iPhones, and sell them for a higher price. You can buy cars, apartments, you can buy stocks, currencies, cryptocurrencies, and so on. So you can actually trade absolutely anything. The trader's job is to find market inefficiencies and take advantage of them. For example, you see that Bitcoin is priced at $16,000, but it should be worth 50, maybe even 100. You all are like, I go in, I buy. In the opposite situation, Bitcoin is priced at $200,000. The market is overheated. Bitcoin is going to start falling soon. You open a short trade, Bitcoin is falling from $200,000, and you can profit from that decline as well. Trading helps you quickly understand the market. If you still want to level up in investments, sooner or later, you'll come across trading in technical analysis courses, in courses on fundamental analysis, or when you start studying some macroeconomics, that is trading one way or another. Fast trading, it helps you to better understand the market. In trading, there is a clear entry point and exit point, which is its second advantage. Trading usually involves working with a fairly strict risk management strategy, meaning we set stop losses and take profits. It's all on time limited and restricts our daily lives. Well, let's say we have $10,000 and we bought Bitcoin, investing that $10,000 when it was at $16,000 and then it dropped to 10, for example. And if we were working as traders, it's precisely with a trading approach. We would set a stop loss at say $15,000 and we would lose much less money. 5x, then we could open another trade with 10K. Here we bought it and now we're sitting here and it has dropped. Another trading advantage is the controlled risk positionally. It's definitely a controversial point. So in investments, as I mentioned too, you can control the risk in a position and you don't have to go all in right away. But nevertheless, as a rule, that's an advantage of trading. The fourth advantage of trading is the ability to use leverage, futures, and, well, to make money quickly. It's a controversial point, I agree. Some might consider leverage a downside, but I would see it as an advantage because if you're serious about making money in the market, if you want to profit from all market fluctuations, you'll likely need leverage. Another advantage of trading, it helps you quickly understand the market again, and if you can learn quickly, if you manage your risk, you can really make money faster, than in investments, but with a lot more time spent, a lot more nerves, and a lot more actions. Is it really possible to boost a deposit? I think that's a bad idea. So, if you want to boost your deposit in trading, so to speak, it probably means that you want to gamble and put your entire deposit, so to speak, on that one trade, or you want to enter with some kind of unreasonable leverage. I've rarely seen that end well.
Excuse me, what?
I would recommend earning your deposit first and trading with proper risk management right away. The first, as in my opinion, key downside is the psycho-emotional state. So overall, trading itself requires a lot of psycho-emotional energy. It demands constant engagement. It's likely to be a constant source of stress for you, with ongoing profits and losses. And trading is impossible without losses.
Surprise, motherfucker!
This is also an important point where beginners often get burned when they're promised 100% success rates for our signals in a Telegram channel and all that.
It's a scam.
Please keep this in mind. So trading will inevitably consist of you making some money and losing some money along the way. Imagine a situation where you just earned $100, or maybe you found it on the street and then you lost $100. Most people will be much more upset about losing $100 than about earning it or finding an extra at $100, simply because that's how we're wired. We are much more stressed by the loss of something we have than by earning outside resources. And trading plays on this very strongly. And the majority of people in trading, they will fail not because they, technical analysis or don't know how to trade. They will fail precisely because they simply cannot adequately relate to the market. Trading, in general, requires more experience and a deeper understanding of the market. On one hand, there's a plus. If you get into trading, you'll learn everything very quickly. On the other hand, there's a downside. If you jump in and make the wrong moves, you can lose a lot of your money. In trading, it's extremely important to stick to your strategy that you initially outlined. Why am I emphasizing this? Unlike investing, because in investing, as we discussed, you buy and hold. Is it important to stick to your strategy? Absolutely, it's important. But what's interesting here is that if you suddenly decide not to stick to your strategy in investing, you need to do some really foolish things. So basically sell at the low, or on the contrary, buy at the high. In trading, it's much easier to do this. So basically, you didn't wait for the entry point. You exited the position too soon. You misjudged the risk, a specific trade. You started trading assets that you didn't plan to trade. In general, there are a lot of different nuances that can trip you up and cause you to lose your money. And in trading, the hardest part is managing your emotions and sticking to your strategy. The next point about trading is that you need to be constantly in the market to make money. That's the advantage of being an investor. If you're making money from long-term growth or from dividends, you bought it and forgot about it. Yes, the returns are a bit lower, but during that time, you can focus on your job, you can focus on your business, your family, healthy sports, and so on. In trading, if you're not working independently, then you're not making money. Some might say, well, you can create a bot, algorithmize trading, and so on. Gentlemen, if someone in the market tells you that there's a magic bot, an indicator and so on, that's definitely a scam, fraud, a ripoff and so on. Never fall for that. There is no such thing as a magic bot, just one. In any case, even if it's some kind of algorithmic trading, you constantly need to refine and improve the bot. You need to enhance its algorithms, adapt them to the market and so on. There are no magic pills. 95% of traders lose their money. There's statistics showing that more people win in casinos than make money trading meme coins. That's straight up statistics, and it's really hard to argue with that. And indeed, if you want to get into trading, the first thing you need to do is self-analysis. You need to understand what kind of person you are, whether you're ready for such emotional overloads, whether you're willing to constantly learn and grow, and what you really want out of life. And what are your strengths and weaknesses? And based on that, you'll be able to understand whether trading is the right fit for you as an activity, or maybe it's better to just become an investor, go to work, run a business, and save money so that it can work for you and bring in even more money. There's just one thing I need to clarify. There are indeed periods when it's better to trade and when it's better to invest. If you see that the market is currently in an active phase, bullish, everything is rising, assets are skyrocketing, no matter where you look in the trading terminal, everything is going up. And during this time, it's definitely better to trade. We're taking a specific trade, setting a stop, and calculating how much profit we can make, because during such a market period, your investments may result in a drawdown for a long time. When the market is growing too, actively, with serious pumps in assets, it leads to the fact that sooner or later they all deflate. And on the other hand, if we talk about the market being stagnant, in consolidation or in decline, for example, in the last year, altcoins and Bitcoin were just sitting at the bottom a couple of years ago, nobody wanted them. It's just impossible to trade in a sideways market. It's a good situation for investments. Why? Because a sideways market is the worst situation for a trader. If you've ever traded in a sideways market, you understand for a trader to make money, they need trending movements. So how do we work in trading? We can see that a trend is starting to develop. Okay, we're waiting for a pullback to happen. On the pullback, we build our position. The next trending movement is occurring. In a sideways market, instead, we find ourselves in a situation where a trend is starting to develop and a pullback happens. And this is not a pullback, but the lower boundary of the sideways market. The price is going back. It's usually in a sideways market that traders lose their profits. So there are some peculiarities, some nuances here. Of course, in our time in 2025, entering into investments in the broad market is a dubious undertaking. But trading and learning and understanding how the market is structured and works is totally fine. It seems to me that the path from trader to investor is a fairly standard story for most people I know in the market, and it happened exactly the same way for me. So I got to know Bitcoin for the first time. In 2017, I bought a couple of $1,000s worth of Bitcoin and a couple of $1,000s worth of Ethereum. I pulled all of that out from the top, but I forgot. Then I started trading in 2020, I think it was in 2021, buying and selling some crypto. In 2022, I was actively involved in trading, and I was also trading in 2023 trading. At the end of 2023 and into 2024, I shifted more towards investing. Just because other projects started to emerge, there was less time left. I got tired of it. It's constant stress and so on. But it's precisely this trading background, the constant chart watching, the ongoing news monitoring, and being immersed in the market that gives you a significant advantage in the future. Among other investors, you can feel the subtle nuances of what's happening in the market right now. You can already tell just from the chart how detached the market is from reality and what's really going on with it. These are subtle moments. They come together from a very large number of factors. You can connect things like shifted analysis, volumes, trend strength, moving averages, and so on, but you can already feel it just at your fingertips. And moving from being a trader to an investor, in my opinion, is a really good idea. And once again, folks, I want to emphasize that if you currently have very little money, like $1,000, $2,000, $3,000, or maybe even just $100, I don't see the point in trying to boost your deposit. Spend time improving your skills at work, in your career, to become a more valuable specialist, or even start a business. Maybe just completely change your life, learn a new profession that pays more money, for example. And of course, all of this should be accompanied by adequate financial literacy. On some intuitive level, everything was always more or less okay with her. I already mentioned that I started saving some of my first money when I was around 14 to 16 years old. And actually, I didn't have any problems with that. But if you have any issues, I definitely recommend getting a bit more familiar with financial literacy. See you soon.